In our last video, we have talked about motivation behind mergers and acquisitions. If a company decides to buy another company, the buyer will need to approach the management and board of directors of the target firm. If the board of the target firm agrees to terms of an acquisition, the next step is to gain approval from the target shareholders and regulators. But things do not always go smoothly. A buyer may face resistance from management of the target firm from the very first beginning. In this video, we will be discussing some tactics a buyer can use. As a preliminary step, a buyer can begin its acquisition with an initial acquisition of the target shares in the open market. This strategy is called a toehold. In a toehold purchase, a buyer accumulates less than 5% of the target shares. One reason to have a toehold purchase beforehand is to lower the average cost of acquisition, because the stock price of a target firm usually increases when news of a potential acquisition became public. You may think of it as a demand shock of the target company's equity. Besides, the bidder gains some shareholder rights with its purchase of company stocks. But toehold purchase can also be risky because establishing a toehold needs a buyer to spend money on open market purchases of target company stocks. Potential costs may occur in the event the acquisition did not succeed. Next, a buyer may attempt a bear hug towards its target management if the buyer suspects that it will not be welcomed by the target. In order to gain shareholders' support, a buyer will offer a price notably higher than the current market price of its target. In a bear hug, a buyer writes a bear hug proposal to get the attention of the management of the target firm. The proposal would indicate its interest to acquire the target and, at the same time, imply the intent to go directly to shareholders or threat to lawsuit if the target management rejects. For example, in year 2001, American International Group, AIG, bear hugged American General Group, AGG. In its bear hug proposal, AIG wrote, "You can be assured that we will do everything in our power to see this transaction through to completion." If target management rejects an offer, a buyer may go directly to buying shares from the target shareholders through a tender offer. By definition, a tender offer is a public offer by an acquirer to all shareholders of the target company to tender their shares at a specific price during a specific time. Tender offer is one of the most frequently used tools of hostile takeovers. In another scenario, a firm may use tender offer to repurchase its stocks. When tender offer is applied to takeovers, a buyer would usually bid a price substantially higher than the current market price of a target. The purpose is to motivate a large number of shareholders to sell their shares. After news of a tender offer became public, the share price of a target would usually start to increase till approaching the bidding price. Because if the merger went smoothly, the acquiring firm will purchase the shares at its bidding price, but the share price of the target is likely to be slightly lower than the bidding price, because there is still the possibility of a failed merger, in which case no shares would be tendered. For example, a buyer may bid a price of $40 per share for target, and the target is trading at $35 per share. After news of the tender offer becomes public, share price may increase to $38.5 per share, which is still below the bidding price of $40 per share. With the approaching of the closing day of the offer, the price differences tend to narrow. This pattern of price movement motivates an arbitrage trading strategy. If trader thinks there is high probability the tender offer can be completed, the trader should take a long position in stocks of the target at price of $38.5, and then wait for the price to increase and make a profit. There are certain advantages of a tender offer over an open market purchase in takeovers. If a company opts to purchase shares directly in the open market, there is huge uncertainty in timing and the cost of capital, and the buyer needs to spend money upfront when purchasing a target shares. If the acquisition did not complete, the money spent in open market purchase would be a huge cost. In comparison, in a tender offer, a buyer offers to buy shares at a specific price and during a specific time. There is certainty in timing and cost, and in order to secure control, a tender offer is often conditional on a majority of shareholders agreeing to tender their shares. So, a buyer does not need to pay in case of failures. If the management of a target company refuses a merger, another takeover tactic we are going to discuss is a proxy contest or proxy fight. Proxy here means shareholder vote by proxy. Most shareholders do not physically attend shareholder meetings to cast their vote. They can elect somebody else to vote on their behalf. In a proxy contest, an acquirer seeks to gain support from the shareholders and use proxy votes to replace the current management. For example, in 2008, Microsoft made an offer to acquire Yahoo at a price of $31 per share. Yahoo was trading at $19.18 per share, so the offering price represents a 61% premium to the market price. But management of Yahoo rejected the offer. Microsoft withdrew the offer in May. Shareholders of Yahoo may not be happy about the management, and 2 weeks later, activism investor Carl Icahn launched a proxy fight against the management of Yahoo. Proxy contest is also used as an investment strategy. An activism investor like Carl Icahn would first buy shares in companies that are undervalued and then try to gain control over board through proxy fights, and next bring changes to that company and boost its share price through activism strategies, such as replacing the management, changing business strategies, or restructuring the company. Okay, in this video, we have discussed several strategies a buyer may use when facing resistance from the management of a target firm. Thanks for watching. In the next week, we will continue with our discussion of buy-side mergers and acquisitions. See you next week.